Okay, folks, the speculative market bubble has officially bursted. So many people are predicting we're going to go into a full-blown bear market, and we're only just seeing the cusp of it. And I think that's complete bullshit. I think the worst of it at this point is behind us. Whether we go a little lower or higher from here, nobody truly knows. But what I'm going to explain to you is if you go into the speculative aspects of the market, I'm going to give you some pointers on what you should be looking for, because if you have a percentage allocation in your portfolio for these speculations, these high growth potential returns of upwards of 1,000+%, this is going to be the video for you. This video will inevitably make you rich, as so many of you were calling me out when I was talking about this earlier that I didn't give any details on where to look for specific companies that could offer those high growth returns. And I'm not going to give you any specific companies, but I am going to dive down into what exactly I would look for. Now, for this first place we have to go to look for the absolute most percentage return in the future, in my opinion, is going to be the crypto space, because it was by far the most speculative, and anywhere the most speculation is obviously returns the highest results. Now, first and foremost, guys, I'm not into any of these. I don't buy any of them. I'm still buying Bitcoin, and I'm using Shakepay, which still gives me free Bitcoin every day through this bear market. And I'm going to leave the link in the description below, because you have to come in through an affiliate. If you're Canadian, you can literally get free Bitcoin every day for logging the app and shaking your phone. Deposit $100, you make 30, I make 30. But there we go with the disclaimers. Now, before we get into stocks, I know many of you just want to hear about the stock side of it, but hear me out. This is going to be crucial. Now, crypto by far has seen the biggest crash next to small caps and high growth based small companies, right? But the thing you have to recognize is that some of these cryptos are correlated to real companies that right now are early stage, and right now most cryptos don't make any money. They're all fugazi. They're all based off hype, future expectations, and speculations. But the reality is, if you go through these, and I think one place I would filter into is the metaverse and video game aspect of cryptos, because inevitably these are going to be the first platforms to start generating real revenue. And those companies that can pull it off, like Star Atlas, just to name one, I mean, it's fully crashed at this point, guys. So if you've got a couple $1,000, you have a few friends where you can each come up with a few $100, $500, pick 5 or 10 cryptos you believe in, and just start accumulating them down here, guys. Inevitably, if one of those work out, and you only need one, I'm talking about 1,000% gains. We have not seen the end of the crypto bull market. This is like the early day .com era here, guys. The evolution of the first starting of the internet. This stuff is going to disrupt some major technologies, and now would be the time to pay most attention, now that it's the most hated. Now, the second most hated thing, obviously, being small caps, and there's no better sign of the small cap growth phase than Cathie Wood's ARK Innovation ETF. Now, I'm not going to directly tell you to buy the ARK ETF, but something tells me sometime in the future here, as hated as Cathie Wood was, as hated as Tesla was in the 2019 era when it dropped 50% before that crazy run, I think there's some real potential here. But honestly, what I would prefer anybody to do is look for individual companies, maybe even start with the companies in the ARK Innovation ETF. And I'm going to kind of share with you what I would specifically look for in these kind of company types. And I'm going to use Zoom as an example, because I don't want you chasing super mega small cap companies that have no bottom line EPS, and they're really, really speculating on what's going to happen tomorrow, which I don't want you doing that, because the chances of getting a real rate of return is going to be very diminished. But what you can do, and I'm going to use Zoom as an example here. I mean, Zoom is kind of this mid to small cap range. It's probably where you want to play around. It's down 80% here, guys. I really don't see it going down 90 or 99%. I really think the bear market's hit this one at its fullest. But Zoom is a great example of a company that has done a fabulous job, even coming out of this pandemic, growing their bottom line free cash flow. Those are the numbers that matter the most, that bottom line EPS, and they haven't missed a single earnings period yet based off analyst expectations. So these are the kind of companies you need to look for, the ones with free cash flow and growth. Now, it gets a little more complicated when you're talking about companies, say, like Shopify, which I would put in that mid-cap range, because Shopify is making a lot of investments into their future, which is eating into that short-term free cash flow. So we can see, guys, their free cash flow growth, though still growing, isn't nearly as, exacerbated as it probably could be. So the thing you have to ask yourself here is, at the current discounted rate, do you think those investments into those fulfillment centers like Amazon is doing is going to pay off sometime in the near term? But Shopify is another one of those kind of companies that I would think could offer you some pretty substantial returns. However, we want explosive growth, like 1,000x returns. And, something like Zoom or Shopify, though, could offer really high growth returns. I don't think we're going to see that 1,000xer. Now, we got to kind of expand a little farther into some more riskier baskets. Now, maybe I could say Baba stock could offer some really great returns, because this stock is exuberantly cheap, incredible free cash flow growth. Charlie Munger's been buying it. However, like I said, we want 1,000x. We want to make real money here. So how do we do that with these kind of mid to mega cap based companies? Well, to put it in perspective, if you think PayPal's cheap, If you think Google's cheap, if you think Amazon is now cheap, guys, if you think Facebook is now cheap and you'd be willing to buy these at the current prices, well, you should be really considering the triple leverage TQQ ETF. Now, I've never really been a proponent of this, but again, I'm not looking for that volatility in my current portfolio. But again, if you have maybe 5-10% of your portfolio dedicated to looking for these unicorn based events, like I said, if you think like I think that we're starting to see the bottom of this bubble that is deflated, and like I mentioned before, small caps, speculations, crypto, anything that didn't have free cash flow got absolutely devastated. A lot of things got dragged down with that, and then it dragged into the mega caps, and now we're seeing it drag into real estate, and inevitably every aspect of the market tends to get hit in one of these recessionary periods, and commodities outperform. Problem is, I don't see you making 1,000x return on an Exxon Mobil out there, even though you can get steady returns and at least get something in this market. But again, if you have that risk for tolerance, guys, and you really think the vast majority of the QQQs are going to do very well, which if you don't know the QQQ ETF, guys, it's just the NASDAQ weighted ETF with Apple, Microsoft, Amazon, Google, Facebook, Tesla, Nvidia, those kind of companies. And, you know, even Nvidia's down like what, 50+% or something like that. Now, I'd say Apple, Microsoft, maybe still a little premium value, but basketing these together should near term give you much better results, because I really think if you think PayPal, Google, Facebook, those kind of companies are cheap, they'll make up for any losses we might see in, say, Apple or Microsoft, if you think those ones are overvalued here, guys. But the thing right now is you have to recognize is that people are just burning the markets alive. Like literally, I've never heard so much bearish sentiment, guys. And just like we heard so much bullish sentiment coming into 2021, now that we're kind of in the inverted period, this is where there's so much blood on the streets that accumulating higher risk assets that have somewhat of an edge toward them, whether it's free cash flow, whether it's mega caps that are oversold that you can triple leverage, or whether it's these crypto projects. I think people need to understand we're here. We're at the bottoms now, guys. This is where DD can really pay off for some substantial future-based returns. I know a lot of people were going the inverse route during this period, and by shorting the TQQ, you can triple leverage yourself into the inverse. So if TQQ keeps going down, I mean, you could realistically use the short ETF version of it and make the inverse return, which is up 65% year to date. But inevitably, over a long period of time, TQQ has always outperformed, guys. It has done very, very well if you can take a zoomed out view of it. So I would say TQQ gives you a little bit more risk adverse, even though it's highly risky. It's a volatile, but it's a lot more adverse than some of these individual stocks that you might be buying, because you're buying that diversified basket here, guys. So I hope this really kind of clears up some of those Q&As, because so many of you guys were just reaming me out for not giving enough direct details on where to kind of make a lot of money in this market, because I keep saying the bottoms are coming, guys. Now that real estate's falling apart, there's not another domino to fall off. So once real estate gets hit, we could still see some balance sheet disruption, whether it's with e-commerce slowing down and stuff like that. But the fact of the matter is we are now truly in discounted territory. So if you have patience, you look in 1 to 3 years out, I would really start fixating on these specific aspects of these speculative markets. And I promise you, you don't need 1 or 2 of these to really work out well to make up for any of the ones that get a little more diminished or don't go anywhere. But again, the downside from here, guys, I promise you is more than likely limited. So at this point, I'm going to pass the question off to you. I'd love to know what you think about all this in that comment section below. In light of this, stay cool, stay awesome, and as always, I look forward to catching you in the next one.